Welcome back to financial management class. This is module 8, and we'll be talking about dividend decision in financial management, dividend decisions in financial management, and the dividend decisions are a key part of financial management as it determines how a firm allocates earnings between reinvestment and shareholders distribution. That is, it talks about how the firm allocates earnings as per whether to reinvest the money in whatsoever project or to distribute it as dividend to the shareholders that are in charge. And these choices influence investors' perception, share price, and companies' financial health. So we'll be looking into the different types of dividend that we have, the key dividend theories and factors affecting dividend policies, and providing a foundation for informed decisions that aligns with corporate goals and shareholders' expectation. What is dividend? A dividend is a portion of a company's earning which is distributed to shareholders as a reward for investment. It can be paid in cash, stock, or other assets, reflecting the company's profitability and financial strategy. So it's a portion of a company's profit which is distributed to shareholders as a reward for the investments they've made, and this can be in cash, stock, or other assets. And why is dividend policy significant? What's the importance of dividend policy? As we look at this, dividend policy balances retained earnings for reinvestment and payouts to shareholders. It affects capital structure, investors' satisfaction, and market valuation, signaling financial stability and management quality. So dividend policy is actually important in order to bring about a balance in the earnings of for the investments and payouts. The distributions that I said are done to the shareholders, and this will not just be, it affects a number of things: the capital structure, investment satisfaction, and market valuation. And it deals with how stable management quality is. And we talk about dividend approval. Dividends are declared by the board and approved by shareholders. So if perhaps we will talk about the approval of dividends, the major segments who approves dividends are the board and the shareholder, and payments depends on profitability, cash flow, and economic conditions. So consistent policy builds investors' confidence and conveys market signals. So when there is a consistent policy on dividends, it boosts the confidence of investors to invest in such a firm or business. What are the types of dividend that we have? We have the cash dividend, which is most common form and is paid in cash per share. It indicates the strong liquidity but reduces the internal fund. We also have the stock dividend, which is additional share issued to shareholders, conserving cash and signaling growth prospects. We also have the property dividend, and this is paid in assets other than cash or stock, used when surplus non-cash assets exist. We also have the scrip dividend, which is promissory notes deferring payment, which is used when cash is temporarily constrained. And we have the liquidating dividend, which is a return of original capital, signaling downsizing or business closure. And lastly, we have the interim and final dividend, which is the interim is paid during a year, while the final is declared after annual account, usually larger. in amount than the interim. We have some theories that guides dividend, the policy that is being made, and for this we'll be talking about three of them. We have the Waters model, we have the Gordon Growth model, and we have the hypothesis, which is the Gillian-Miller hypothesis. And dividend theories actually attempt to explain the relationship between a firm's dividend policy and its market value or shareholders' wealth. And that is why it is essential that we look into these theories. For Waters' dividend model, what is the core idea of this model? It's dividend policy affects firm value based on the relationship between internal rates and of return and cost of capital. And the key point is that if R is greater than K, you retain earnings to maximize value. Also, if R is less than K, then you have to distribute the earnings as dividend. However, if R is equal to K, then dividend policy is irrelevant. So these are key points of the model, and this actually helps to be able to guide the firm in what to do as pertaining dividend in this point using this theory. And there are criticism of this theory, and this assume constant rate and ignores external financing and market imperfection, also limiting real world application. These are the criticism to the theory. We have the Gordon's growth model and the model. The Gordon's growth model supports dividends relevance by emphasizing investors' preference for certain dividends. So it talks about like bird in hand theory, and it assumes constant growth and no external financing. Also, higher dividend, it believes that higher dividend increases stock price by boosting investors' confidence. The hypothesis argues that dividend policy is irrelevant in perfect market firm value. Firm value depends on investment decision and not dividend payouts. So for investors can create their own dividend by selling shares, ignores taxes and market imperfection. This is what this model or hypothesis states, the hypothesis, that dividend is irrelevant in perfect market, and that firm value depends on investment decision and not on dividend payout. So this is the theories that we look into as we talk about dividend policy. What are the factors influencing dividend policy? The first is profitability, and it talks about higher profit enable regular and larger dividends. Losses may reduce the payout. So it is the more you make the profit, the more the dividends will be. However, if there are losses, then it reduces payout also. And for liquidity, another factor is liquidity. That is, cash availability is crucial. Firm with tight cash flow may retain earnings despite profit. So irrespective of whether they earn or make profits, if there is no cash available, then the firm will retain it, will bring it as retained earnings. Another factor is growth opportunities, which means that growth-oriented firm retain earnings for expansion, reducing dividend payout. That's another reason, factor that influences the dividend policy. Another one is shareholders' preference. So investors' needs vary. So you can have people that are income focused and prefer dividend, while others can actually prefer capital gain. We also have other factors that influence the dividend policy, such as legal constraints, tax consideration, economic consideration, where inflation and downturn may force firm to retain earning to maintain liquidity. And lastly, industry norms and control. This talks about the company's aligns with competitors' policy and consider control issues in dividend decisions. In conclusion, dividend decision balance profits distribution with reinvestment for growth. Understanding dividend type, the theory, and the influencing factors as we've looked at it, equips manager to align policy with corporate goals and shareholders' interest. So a well-structured dividend policy fosters investment confidence, supports sustainable growth, and enhances long-term firm value, contributing to overall financial management. And this is what we have to talk about for dividend policy. Next class, we'll be talking about working capital management.